All right. Okay, thank you so much for coming back to see this presentation. Thanks a lot for including our paper into the program. This is joint work with Alessandro Fontana, who is here with us, flying from Frankfurt, who works at the European Pension Insurance Regulator called EIOPA. Peter Jakubik, who used to also work at EIOPA, now at the IMF. Ralph from here, and Wenxin at the BIS. The usual disclaimer from the official institutions applies here, and this work is possible through an external research platform that was launched by EIOPA, which they share data with external researchers. Great resources for all of us. One slide on motivation. For regulated financial institutions such as bank and insurance company, we know government bonds are special. They receive favorable regulatory treatments when banks and insurance companies, especially in the context of Europe, holding government bonds, regardless of the underlying sovereign risk, all these bonds are considered to be risk-free from default risk and from counterparty risk and also from concentration risk. For pension insurance in particular, I'm going to use this acronym ICPF to refer to insurance company and pension funds throughout this presentation. These institutional investors have demand for long-dated duration, and government bonds again become very natural assets to hold on their balance sheets. So despite all these nice things about the government bonds, there is a big problem. And the problem is the government bonds, especially coming from safe countries, are in very scarce supply relative to this very large ICPF sector in Europe. In our paper, we're going to make use of the newly available microdata on European insurance companies through the Solvency II filings to shed light on the global asset allocation decision of these important institutional investors. We're going to supplement our main results from insurance companies, also using the enhanced BS banking statistic to share similar stories about a bank's portfolio composition. And a key part of this paper is to connect the cross-country heterogeneity in the structure of the domestic financial markets across all these countries with the heterogeneity of their global portfolio that goes beyond the usual conventional home bias that you might be familiar with. Quick slides on the overview of the results. Before we dive into the intricacy of the global portfolio, we're going to first see some macro level broad cross-country status facts that suggest the size of the ICPF sector is closely related to the development of the corporate bond markets across country. Here I'm using the word corporate bond in a very broad sense. In this presentation and in the current version of the write-up, corporate bonds refers to any other fixed income security that is not issued by the government. Our key results on the portfolio suggest that despite high level of international diversification, we see that the fixed income portfolios of our insurers and banks closely mimic the characteristics of the domestic financial markets due to two newly documented international portfolio frictions. The first friction I'm going to discuss is termed as the domestic projection bias, where we show that the characteristics of domestic financial markets actually spill over to the foreign investments of these institutional investors. A good example is insurers based in Netherlands. The country has a lot of supply of corporate bonds. When it invests abroad, it also tends to pick up more corporate bonds as opposed to invest more in government bonds to offset this deficiency that there's not a lot of government bonds supplied at home. The second friction we're going to document is phrased as the going native bias, which suggests that when foreign insurers and banks operate in the local markets, instead of bringing the global perspective, running a global CAPM-ish model, they exhibit very similar domestic biases, just as the domestic companies. So in other words, when in Rome, do what the Romans do. The paper also includes a theoretical framework to explain these empirical findings that features a convenience or negative convenience yield, which brings down the yield on government bonds, and in addition to the regulatory and self-imposed risk management constraints of these institutional investors. And very importantly, you are in the long-term asset management section, not behavioral finance. We refer to these portfolio fictions as biases, but the root cause might be rational or behavioral that we don't take a stand for now. Okay, so first part of the presentation, I'll show you some big picture cross-country status facts just to position the findings on the portfolio. So figure 1 of the paper, this confirms the fact there is not enough supply of safe government bonds. Why do I say so? The first bar consists of 3 assets. Insurers' total assets showing red, the pension funds' total assets showing yellow, and the purple is the bank securities holdings showing in purple. If you add up the stack of these 3 bars across different regions, you see the sum of the ICPF sector together with bank security portfolio significantly exceeds the size of the government bond outstanding, which is the blue bar, the second blue bar. And the way we group the countries is the first block is the core euro area countries with low interest rate. The second block is the peripheral euro area countries with high interest rate. The third block is other non-euro area advanced economy, which include the Scandinavian country and the UK before they exit. And finally, we have the non-euro area emerging Europe. So as you can see, this gap between the height of the first bar and the second bar, so the size of the government bond markets relative to the ICPF sector size together with the bank security holding, that gap is particularly large in the core euro area countries with low interest rate and also in other advanced European countries. So when there is not enough supply of safe government bonds or just government bonds in general, where do you go? You go to the green, and that is our broad definition of non-government bond fixed income, or labeled as corporate bond in this case. And that is the most important portfolio margin we're going to study. Okay, so but on the cross-country level, again, setting aside the portfolio characteristics, what we see is that the relative supply of corporate bonds in total domestic fixed income, as being shown on the vertical axis here, which plots the share of corporate bonds in total fixed income outstanding for each country, is highly correlated with the size of the ICPF sector, which shows the log ICPF sector size over GDP on the horizontal axis. And you might wonder, I'm plotting the share of corporate bonds over total fixed income on the vertical axis. Is this relationship mainly driven by more corporate bonds in countries with larger ICPF or less government bond in countries with more ICPF? And the answer is, from this slide, the answer is entirely coming from more corporate bonds. So here we show the corporate bond over GDP on the left vertical axis and the government bond over GDP in log on the right-hand side vertical axis. So speaking in terms of government bonds, you might think the supply is largely driven by fiscal policy, which is somewhat orthogonal to the demand from the ICPF sector, whereas on the left, you see a very strong relationship that countries with larger ICPF sector just has more corporate bonds, period. So the natural hypothesis is the supply of corporate bonds may well in response to the demand from the sector. And this relationship in terms of corporate debt to GDP over ICPF sector size actually holds both for financial corporate bonds and also for the non-financial corporate bonds. As you can see, the relationship is very similar, both very strong in both of these 2 charts. And this unconditional relationship isn't going away if you control from some broad notion of financial market development. Yes, it is true that in richer countries, you tend to have more corporate bond, you tend to have a bigger ICPF sector size, but even after controlling for usual variables such as per capita income or the size of the banking sector, you still have a pretty significant top line results that the size of the ICPF sector remains to be pretty correlated in a positive way with the share of the corporate bond in the overall domestic fixed income markets. And the final macro facts I would like to highlight before going into the portfolio is this one, which is not a big surprise. In countries with more corporate bond supply, larger ICPF sector size, these are the countries that tend to have lower domestic interest rates. These are also the countries that tend to have lower sovereign default risk as measured by sovereign CDS. Okay. So now I'm going to start talking about the status facts on global portfolio allocation. One slide on the data, the ballpark of the results is derived from a micro data from EIOPA Solvency II regulatory filings. Our sample consists of life and composite insurers. We focus on solo, which is like, you can think about it, it's like one subsidiary in each country. Even if the parent may have different subsidiary, each subsidiary counts as one independent observation in our sample, and we're able to connect them. We exclude the so-called unit-linked products on the asset side of the insurer's balance sheets. These are mutual fund style products, which allows investor policyholder to have a full risk pass-through. Insurers do not return risk on these products, and therefore we exclude them from our portfolio composition. Our sample period begins together when the EIOPA Solvency II took into effect and ends in 2021 Q1. 30 sample countries that are in European Economic Area, which include the UK prior to 2020 and includes both Euro area and non-Euro area countries. One nice thing about the Solvency II on the asset side is we're able to look through the so-called collective investment units and assign them to the respective asset class, currency, and country groups. And we're going to broadly divide our list of assets into 3 categories: government bonds, anything that's fixed income security, but not government bond, broadly labeled as corporate bond, and equities. I will not have time to talk much about bank in today's talk, but in the paper, we also make use of the enhanced BAS locational statistics to document a set of very similar facts for global banks operating in Europe. Okay, so this is one key chart which highlights a significant heterogeneity in portfolio allocation across insurers in different countries. This to us is a big surprise. Europe provides a very natural setting for us to investigate this story because the regulation for banks and for insurance companies is universal across all countries. All insurers domiciled in any parts of the European Economic Area are subject to the same Solvency II regulation. In addition, all these are countries without obvious form of capital control or restrictions to capital mobility. So if you think regulation is the same, capital markets are free, perfectly mobile, you would expect insurers operating in these markets to have very similar portfolio. But what this picture showing is exactly the opposite. Almost everyone, if you group them by country, has a distinct portfolio. If you just look at the share of government bonds, which is the red bar over the total, that ranges from about 10% for Norway all the way going to close to 90% for Hungary. And in addition, there's also varying share for corporate bonds, and generally speaking, insurers do not hold much equity, except outside a few examples of the Scandinavian countries. So the key portfolio margin we're going to look at is the share of the blue, the share of corporate bonds in the sum of the blue and the red, the share of corporate bonds in the total fixed income allocation. Okay, so how is that share determined in the cross section? As you can see, that share varies a lot across country, close to like 100% for some of these emerging Europe countries and high risk peripheral European countries, but that share is very low for Scandinavian countries and for core Euro area countries. And very interestingly, so the share in the portfolio of the corporate bonds in total fixed income being plotted on the vertical axis is highly correlated with the macro facts you saw. That's the relative supply of corporate bonds on the horizontal axis in the home country, okay? So that's the key fact in the paper, that the portfolio share strongly mimics the characteristics of the domestic financial markets. So for people who have read papers on home bias, your natural response is, okay, maybe this is not a surprise. If everybody just invests at home, whatever is out there, given I'm so large, I'm just going to pick up that characteristics in my portfolio. What makes these results even more surprising is in the context of Europe, not everybody is just investing at home. So this chart shows the share of securities for corporates and government bond that is invested at home. The average home share of fixed income investment among these European insurers is only 46%. So more than half of their investments are actually happening abroad. So they don't, a Dutch insurer doesn't just invest in the Dutch security, they really go abroad quite extensively. But how can you still have these results that their overall portfolio composition follows so closely to the Dutch domestic characteristic? It has to be the case that when a Dutch insurer go abroad, it picks somewhere that is very similar to the Netherlands, okay? So that introduces our first portfolio bias called domestic projection bias, which means this domestic bias spill over to the foreign investment portion of these insurers. So what we are showing here is the same, very similar plot where we have the relative supply of corporate bond in the domestic market plotted on the horizontal axis. And on the vertical axis on the left, you have this more natural perspective to look at the share of corporate bonds in the domestic fixed income investment, whereas on the right, you have the share of corporate bonds in the foreign or international investments of the same insurers domiciled in the same country. So what you have here on the left, you have the natural hypothesis. If there is a lot of corporate bond at home, you invest more corporate bond within your domestic portion of your fixed income portfolio. On the right, you just don't see much offsetting. So if anything, there remains to be a broad positive relationship for insurers domiciled in countries with a greater supply of corporate bond. When they go abroad, they still tend to pick up more corporate bonds as opposed to investing more in government bonds to offset the lack of government bonds at home. So if you think about everybody is operating with a global CAPM in fixed income, you would expect the null hypothesis to imply a negative relationship between what you do abroad versus what you have at home, but that's clearly not what we find in the data. It is true if you go to the very right tail, look at the countries such as Sweden and Denmark, where you see there might be some offsetting, but we're already talking about in countries with more than 80% of domestic corporate bond in domestic fixed income. When they go abroad, they still nevertheless invest up to 60% in corporate bonds. So that's the first bias, the domestic projection bias. So if the foreign investment portion of these insurers is not very helpful to get us to the global CAPM, could we have some hopes on the multinational to come to in these countries and to rescue us? And the answer is unfortunately no. This is the in Rome do what the Romans do example, where we're plotting the same thing that links the portfolio share in corporate against the relative supply of corporate in the home country. This time we split our sample between the domestic company, these are true local companies, from the local subsidiaries of foreign companies shown on the right. The two charts are not really distinguishable from each other. If anything, this very strong relationship between the relative supply and portfolio share is slightly even more pronounced for the local subsidiary of foreign companies. So despite this large potential of having large integration and centralization, we just don't really see much that's showing up in the foreigners' portfolios when they operate in the home markets. So that speaks to this connection between domestic characteristics and the relative, in terms of relative supply of corporate bonds and portfolio statistics. We also find very similar results if we look at other domestic characteristics, such as the domestic government bond yields is highly correlated with the portfolio yields of the countries. If you're in a safer country, your overall portfolio is yielding higher. And if you're a safer countries, your overall, if you're in a safer country, your overall portfolio yield is lower. And if you're in a safer country, your overall portfolio risk is also lower. So that's another way where the structure and the characteristics of domestic financial market is strongly mimicked in the overall portfolio characteristics, okay, due to these two types of biases. In the remaining couple of minutes, I'm going to discuss why does this matter? Like what we have seen is a large cross-country heterogeneity in terms of the share of corporate bonds in the investor's asset portfolio. And it makes a difference because we know investing in corporate bonds is more costly than investing in government bonds. Government bonds are exempt from these capital charge associated with credit risk and associated with counterparty risk and concentration risk. But any non-government bonds, even though it can be safe corporates, are still subject to capital charge. So insurers can adapt to these risks, thinking about the Dutch insurers, the German insurers that have more of corporate bonds on their portfolio. They can adapt these risks through different ways. The first thing they can do is they can simply tolerate a slightly lower regulatory capital ratio, which in the language of insurance is called the solvency capital ratio, this coverage ratio. And the implication of that is with a lower regulatory capital ratio, the insurance company is riskier. Or they can operate with more equity and lower leverage, and this makes the insurance business more capital intensive in a particular country. And thirdly, they can also adjust the design of the insurance products and therefore exposing the policy holders to more risk. And in this way, they pass the risk of credit to the policyholder. What we find in the data is really a mixture of all these three forces on aggregate. What we see is that with one standard deviation increase in the corporate share across different companies, so here we're using our micro level results, we do see a significant deterioration in terms of the gross risk exposure. So yes, holding more corporate bond does show up in terms of having more gross risk calculated under the solvency framework. And to offset this deterioration in the overall risk profile of the company chose a combination of lowering the leverage, using more loss absorbing capacity, i.e. the passing the loss and the risk to policyholder, together with tolerating a modest deterioration in the SCR coverage ratio. And therefore, as a combination, both the households, the insurance company themselves, and also the expense of the insurance business, all these are accommodating for the companies that are taking more corporate risk. And there are many different explanations for these facts that we're documenting in the paper. And in the interest of time, I'm not going to go through them. And just to wrap up, what we find is the portfolio allocation is predominantly driven by the characteristics of domestic markets, and it appears that these frictions are very challenging to overcome and has important implications for topics such as the European capital market integration. And I'll just stop here. Thanks.